This video is going to cover lesson 6.1 in the Options Blackboard Educational Series on bull put spreads. Should have already gone over the content in the lesson and become familiar with the bull put spread. To review quickly, we see that this is a credit spread that involves buying one out of the money put option and writing a further out of the money put option. Because you receive a net credit, your ultimate goal is for both of the options to expire worthless and to keep the net credit. In the lesson, we have an example as well as the risk profile and an overview of the Greeks. We can see that this is a theta positive play and a vega negative play. So let's pull up our Thinkorswim paper money account, and we're going to actually show you how to set up an example of a bull put spread. And what you'll want to do after the lesson is go back and set up your own. So we're going to pull up the profit, and what I like to do now when I'm opening bull put spreads is I look for stocks that have recently pulled back to strong support levels or to areas of consolidation where I think they're going to reverse and head back up. The reason for this is obviously there's going to be more premium in the put options. As stocks go down, generally implied volatility rises. We can actually see an example of this here as pot pullback. Now our entry would have actually been better a couple of days ago, but certainly you could still jump in at this position. We see it pulled right back to the 105 support level. And implied volatility was at that time spiking. It's actually since declined, which means this position, even if it had traded sideways, would be positive because of that. So let's say though that we're just catching this trade and we're still interested in selling some out of the money put options and keeping the credit. We're going to go to our Analyze tab, pull up the option chains for potash, and the 20 days till expiration. I like the looks of this. So we've got here, let's see, we've got $5 increments between the strike prices, which means in order to find our risk, we're going to take whatever credit received and subtract it from $5. Now we can see just by looking, if we were to sell the 110s and buy the 105s, that's actually a pretty good credit. Now what you have to remember is this is actually at the money option, which means any pullback in the stock, you could get stopped out very easily. Because you obviously want to have a stop loss in place. Let's just say we're very bullish for any number of reasons right now, and we're going to set up the bull put spread. The Thinkorswim platform makes it very easy. All you have to do is right click on the strike that you want to sell, go to sell and select vertical, and it automatically pops up our bull put spread down here. And we can see that we would get a credit of $1.83 or $183. So now what we want to do is pull it up on our risk profile and have a look at what it looks like over here. We can see this is actually giving us a very good risk reward. However, we must remember that this option, the current stock price is very close to the option that we're selling, so it's a little bit higher risk. We can see that by scrolling over here, our maximum loss on the trade is $3.17 or $317. And our max profit at expiration is $183. Now what I like to do is, first thing is find out my break even at expiration, and how I do this is I go to set slices down to break even, and it will actually pull up the expiration date for you. So I click on that, and right there we know that in order to break even on this trade at expiration, potash has to be trading above 108.19. Then what I do is I add a slice in order to get the current price, and we see right now the stock is trading at 111.40. So we've got just over a $3 cushion, I guess you could say, for break even. Now again, you have to be bullish on the stock. Anyways, we can see our live Greeks right here, which is very nice. And we see we have a delta of 17, so we're going to make $17 for every $1 that the stock moves upwards. We have negative gamma, which means our delta will be decreasing as the trade moves with us and increasing as the trade moves against us. We see we are theta positive, which means we're going to get $1.68 every day in theta, and obviously theta will increase as expiration approaches. We also see the negative vega of $1.90, which means that for every 1% rise in implied volatility in the underlying stock, we're going to lose just under $2. Now again, I want to cover this. We see that implied volatility has since pulled back, so there's a little bit room to spike up, but I think we can expect to see historical volatility, which is the blue line, start to move back down. So I like this position. I think I also like potash. You definitely have some nice areas where it could easily run up to after the pullback in the stock here. So going back to our trade, let's say that we were happy with it and we wanted to initiate it. We'd very easily right click on the position, confirm and send, and click on send, and that would send it over to the Thinkorswim broker, and they would try to get it filled for us. So now what your job to do is to go back and find one or two bull put spreads that you'd like to initiate. Do your research, go into the Thinkorswim paper money account and initiate the trades. If you have any problems, any questions, or anything else, just go to the OBB discussion boards, post your questions and comments, and we will help you initiate these trades. After that, you can move on to lesson 6.2.